Okay, in this chapter, we're going to talk about equities, stocks. So let's talk about the stock market. So when we're talking about the stock market, basically we're talking about individuals having partial ownership of a corporation. It's a basically, instead of issuing debt, you own a certain percent of the company. If the company were to go bankrupt, those who are bondholders would have a priority stake over the over what's left of the firm, whereas those who bought stock would basically be left with nothing. The stock market, you basically, at worst, you lose all of your money. At best, you can earn unlimited money. And there are two kinds of types of stocks out there. There's common shares and preferred shares. Common shares are obviously the most frequent. With preferred stock, you either get some preferred voting rights or a slightly higher dividend. And there is both a primary market and a secondary market for the equities. The primary market would be during the IPO or in the new issuance of shares. But for the most part, most people are actually buying shares that were issued some time ago. So most of the time people are buying it from a previous buyer. Probably the easiest way to think about why individuals invest in equities is because they generally have some attraction to a company that they know and that they already buy from, and they think it might be a good idea to also be a part owner of that. I'm not holding you responsible for the analysis, so you do not need to do this dividend discount model. What I'll simply tell you is you should take WUSA 311 with me in the fall semester, and we will spend the time to talk about these things. So you're not going to have to do the dividend discount model. The PE ratio does become pretty useful for valuing stock values over the future. And basically what you're doing is you're looking at the price per share and how much that share is going to have in expected earnings over time. So basically, it's a measure of how much I pay for future profitability. If the company is growing a lot, the PE ratio is going to be very high. If it's a slow growth company, you're not going to see as much in terms of the PE ratio. Stock prices are affected by a lot of things. One of these being, the most important of these being the business cycle. So when we're talking about it in terms of the business cycle, obviously there are some stocks that do well when the economy is doing well, and there's some stocks that do well when the economy is doing bad. And so you'd want to know these kinds of things. That would be, there are some that are pro-cyclical, and there are some that are anti-cyclical. There are also stocks out there that are affected inversely by the interest rates. Those are primarily banks. So you can basically build an equity portfolio, a set of stocks that are based on your beliefs of how you think the future economy is going to do and what risks you want to take into account. You can, as we'll talk about in the mutual funds chapter, you can then buy a set of stocks that are all contained in a certain index, a stock market index. The big one being like the Vanguard Fund VOO, that's the S&P 500, and it's all 500 companies that are in that S&P 500. So you can buy all the stocks, not just single stocks. Stocks are heavily regulated thanks to the 1934 Securities Exchange Act and the Securities Act of 1933, all passed after the 1929 stock market crash. And it basically protects investors. And quite frankly, it's existed for nearly 90 years. And it's actually served investors pretty well. You get a lot of information out there and you do get enforcement as well. Now we can complain about how well the SEC is as an enforcer, but that's a different problem or a different issue, I guess, to deal with. Now, back in the middle of the 1800s, there was this belief that stock markets are efficient. And if you believe in the efficient market hypothesis, it's that markets take into account all of the information and they accurately price all of that information. You've got three different levels of this efficiency. I actually think this is a pretty useful way to think about it. There's weak, semi-strong, and strong. How fair do you think the markets are? With weak being a pretty fair market where no one can earn like really weird rates of return. Where everything is also unknown. Or to the other extreme, where if you have a strong, efficient market hypothesis, all is known and there is no profit to be made. I'm not sure we're at either extreme. We're probably somewhere in the middle where it's semi-strong. And then you've got your behavioral finance. And in behavioral finance, what you're doing is you're trying to understand why markets are priced the way they are. This is really the way to make money in the equity markets, because what you're then doing, and this is where Reddit and Robinhood are great places to look at, because what you want to do is you want to get a sense of how the market participants are investing money. In what way are they participating? And what it does is it allows you to buy things that might be very bad companies, but if that's where the market is heading to or heading out of, then you can make money in that space. And that exactly explains GameStop. It exactly explains people that were investing in Simon Properties and other kinds of things. They weren't buying it because of the fundamentals of the company. They were investing in it because of some of these behavioral issues. This is a rather short chapter, and I don't want to belabor it too much because the later chapters are actually going to talk a lot more about general equity investing.